So yesterday's video, we drew these lines, the buying zone, the stop loss range, and the selling range. And yesterday I had to end the video because there was someone at the door. I had to open the door. So let us continue this video. So as you can see, we have the buying range, stop loss range, and the selling range. Okay, at the top 20-25% above the pivot point. So let us move the price forward. Okay. See, the color of this bar continues to change because as I click here, okay, it moves 1 day forward. So one bar gets completed, and that's on a weekly chart. So five five times when I click here, only then that one bar gets completed because 1 week has got 5 daily candles. So if you notice this bar, momentarily it enters that selling zone, but if you carefully see, it has not closed inside that stop loss range. The closing is above that stop loss range. Now, in terms of trade execution, what you could do is, of course, you are going to buy here, okay, and you might end up buying not the entire position that you planned to buy. For example, let's say you plan to buy 100 shares of this company. So when the price enters here, this zone, you might want to start with 50, then add 30, then add the remaining 20. You want to see price action, you want to see volume action, right? Now, in this case, probably there was no volume action. So maybe you bought only 50 shares. Even when the week ended, it is just near average. So it is average to below average volume. Okay. And definitely, this is not a high volume week. So it's either average or below average. Okay. So chances are, while executing the trade, if your original plan was to buy 100 shares, maybe you ended up buying 50, 60, 75 shares, not all, because it's recommended that you buy gradually inside this. Give it some time, buy it over a period of 1 or 2 days, maybe 3 days. If you see sudden spurt in volume, okay, it's like, for example, on Monday itself, the this volume bar reaches the blue zone. That means what? You still have 4 days remaining in the week, and the price has already touched the blue line on the volume, which is the 10-week simple moving average. So obviously, this is going to be a high volume week, and the price might go up rapidly. So in such cases, you might want to buy all the 100 shares. So it really depends on your judgment, how you are reading volume. There are no rules here, okay, because this is a weekly chart. So buy gradually. That is what is recommended by William O'Neill. But your average execution price must fall within that blue zone. Okay, you cannot buy above the blue zone. You cannot buy below the blue zone. Okay, if you buy above, you are buying extended. If you are buying below, you are buying it prematurely. Okay. So let's say while buying itself, you entered with half position, like 50 shares. Now, since you already entered with half position, your risk is not 5 to 8%. Your risk is between 2.5 to 4%. Correct? So that is tolerable risk because your risk is cut in half because your position size is not full. Correct? So why would you sell if the closing price is already, it bounced off that selling range, stop loss range? Why would you sell? You might want to give it some time. Let's move the price forward. See, in the next 2 weeks, continues to move forward. So that's the advantage of the weekly chart. We give the stock some time. We already have the stop loss in place. The hard stop loss is already at that 8% level from your average execution price, which you set with your broker. That's about the limit of it. You cannot take more than 8%. Okay. So you already have the stop loss range. So I will just move the price forward. See, now by the time 2-3 weeks have passed, the price has already way past the stop loss range. So there is no way it can come closer to the stop loss range. And it now that it is trading clearly above the 10-week simple moving average, we have that cushion. Okay. See, anything can happen on any day, it could completely collapse. That is always there. But the probability is very high that it will continue to go up. So I will continue to move the price forward. See now the price enters this zone. So this is a weekly bar, by the way. Okay. Wait, let me complete that. Okay. This is a weekly bar. Now, in this week, the price momentarily entered that green zone, which means you have the opportunity to sell. This is not some 15-minute or a 5-minute chart, okay, where it quickly goes up in the green zone and then quickly falls down. No, this is a weekly chart. Maybe the price will stay here for 4 5 hours or maybe 1 or 2 days before starting to fall. Okay, so you get a chance to sell. You'll have to check the daily chart how the price is behaving there. So you do get a chance to sell there. So that is a typical weekly positional trade. Remember, I have not done liquidity analysis. Before doing this, I did not check the liquidity analysis, comparative analysis, fundamental analysis. So before even you buy, you have to do liquidity analysis, comparative analysis, technical analysis, fundamental analysis, and market analysis. Only then you decide to enter with a proper position size that depends on market conditions. Okay, so that orange trading system that still applies. Okay, so this is how the trade normally looks like on a weekly chart, and you don't have to sell all your shares. As long as the price is above that blue line, that 10-week simple moving average, you could choose to sell partial shares. Out of 100, you could choose to sell maybe half, right? You have multiple options. When the price goes into that green zone, broadly you have 5 options. Number one, sell all your shares. Number two, don't do anything. Okay. Number three, sell half. Number four, sell more than half. Number five, sell less than half. Okay. These are the 5 options you have. Choose as per your judgment. Okay. Depending on market conditions and things like that. So you decide how you want to sell, how many shares you want to sell, but your selling should come. Your average selling price should fall inside that green zone. Okay. Coming back to our the MarketSmith page. So what happened here? Function F11. Yes. So coming to MarketSmith, see this page. When you go to product support, that page is very important. But have a look at this. See, it says blue bar means up in price. So blue bar means on that in that week the price has closed above the prior week's close. Okay, up closing in that week. Down in price, red color, it means in that week the price closed below the close of the previous week. Okay, the red line is the 10-week moving average. This is the blue line on our trading view chart. The 40-week is not required. It is this black line. Okay, that's the 200-day simple moving average. Relative strength line, you already know this blue line. If it is sloping up, that means the stock is doing better than the Nifty relatively. 96 represents the relative strength rating. Then base patterns, this green dotted line, that's the buying price. Okay. Then tight area, you can ignore this. 20 to 25%, this is the profit range. By the way, see you see this tight area cyan color. See, there is a color here. Okay, so this is 4 weeks of tightness in price that is represented by this cyan color. If you can zoom in or do whatever, but I can see that color here. Then 20 to 25% profit range, buy range is 5%, this blue color, 5 to 8% is the stop loss range. So you understand how you would, are you able to visualize how would you execute the trade? So if I click here, see the price enters, if I click here, see the price enters the blue zone. So that day you would end up buying the stock, right? On that day, the volume is like almost half of, like for example, on Monday, the volume reached half of average weekly volume, correct? Which means there is a very good probability that in the remaining 4 days, the volume might exceed the blue line. Okay. You don't have to go to the daily chart to understand volume. Okay. Here itself, you can do that. Then you move forward you notice in the remaining days, the volume did not go up by another half and another half. It actually declined. And then it came down on low volume, which means institutions are not selling. So this is like almost like average volume, 112 million shares, 108 million is the average. So almost average, which means institutions did not sell. Okay, which means what? You should not be selling. Correct? That's a hint. Number one, it's low volume. Number two, institutions are not selling. Number three, the closing is above the stop loss range. So there are multiple reasons for you to not give up on your position. And by the way, you already bought half position. So your risk is already half. So why to sell? Why not give the stock some time to run? Plus, you also have to look at the fundamental factors. If fundamentally the company had been doing well, there is no reason to sell. Plus, you also look at market conditions. If the market conditions are not weak, there is no reason to sell, right? That is how you approach trade management, stop loss management. I will move it forward. Your stop loss will always remain at the low of this red zone. That's your hard stop loss. That don't play around with the stop loss. On the weekly chart, there is no need to move stop loss up and down. You can do it on the daily. Weekly not required. In fact, William O'Neill has written in his book that he didn't use a stop loss at all. He used a mental stop loss because he did not want to show his hand to other market participants like brokers. And when you keep these levels, your broker knows where your stop loss is. You might not want to disclose that information in the market, right? So the people whom you are up against, they should be guessing as to what is your next move, right? So you're buying with a market order, you're getting out with a market order. Nobody knows when you will buy with a market order, nobody knows when you will sell with the market order. This is true especially for institutions, not so true for retail investors, because retail investors don't have the financial muscle to move prices. So for institutions, they wouldn't want to disclose their hand. They wouldn't want to disclose their intentions in the market. And volume is a way of disclosing intentions, right? So that is how the trade looks like. Hope part one and these two parts, the part three and part four, has helped you understand how to look at the chart. What do the colors signify? Why are we using the same colors as William O'Neill, so that there would be no confusion? How would you execute that positional trade? Where would you keep the stop loss? Why would you not sell? Why would you sell partially at in the green zone? Lot of questions we have answered in this video. This is going to be a multi-part video. This is not yet over. We have to still do a lot of discussion. I will make separate video on filters on MarketSmith for positional traders. Another separate video I will make on the specific fundamental criteria to look for positional traders. Those two videos are pending. Plus, we also have to start looking at examples. So we will spend quite some time. We will look multiple examples of this. We will keep drawing these. I will do it practically for you. We will use old charts as per the regulations, and I think this video series is going to help you a lot. Okay, positional trading, the probability of success in positional trading is more than the probability of success in swing trading. Not that I am devaluing swing trading, but swing trading, since it is done on daily chart, there is a lot of noise. You have to be very careful. In swing trading, the key thing is you have to go with comparatively strong stocks, because there is no fundamental strength in those stocks in general. Okay. So positional trading is the main thing, whether you take a trade on daily chart or weekly chart. I will see you in part 5 of this series.